Hi there, welcome back. Let's get into conversation with Mr. Manish Sonthalia, Director and Chief Investment Officer at MK Investment Managers. And Mr. Sonthalia, hi, morning. Thanks so much for joining us on the show. Well, so much to talk about in terms of the market momentum we've seen. You have earnings, you have some stock-specific and sector-specific action coming in. So let's begin by talking about what the mood is like in the market right now, because we have seen a serious range of consolidation recently. What is your take on the market? Do you believe that the kind of cool-off we've seen could make for a good case on a buy-on-dip strategy sort of a thing, or it's just a wait-and-watch momentum in the market right now?
No, I think, we have seen the markets rally one way from March onwards, and we have seen the index rally up to 15%. And we are in the middle of the earnings season. So I think it's the nature of the markets that whenever you are in the earnings period, there's a lot of volatility. And because the markets have moved one way on the upside, there could be some selling that will come about in the earnings season. But I would reckon that these are times to basically buy the declines that you're seeing. This is not a market where you are going to sell on the downtick. So that's what I understand. And I think it's supported by earnings, it's supported by macros, it's supported by global flows, all of that. So I would believe that the market is a buy and dip.
All right, that's a buy on dip call coming in on the markets. Morning, Mr. Sonthalia. This is Shrishti also joining in. But give us some sense that which sectors do you believe offer the best risk reward at this point in time? Because we have just kickstarted the earnings season. A bit of a disappointment coming in from the retail and the IT players. But any sector that you wish to flag off where you believe that the valuation, the growth outlook looks favorable and even the price points?
Public sector banks, real estate, infrastructure, you'll have capital marketplace, consumption, discretionary consumption, particularly, even if the earnings don't come through this quarter, next quarter onwards, you surely should be looking at some sort of an uptick in the consumption. So these would be some of the plays I would believe would be outperforming the rest of the market this earnings season. As far as the IT names are concerned, again, it's not out of the ordinary. TCS reported the numbers pretty much in line, adjusted for BSNL numbers. So all in all, large caps would have -1 to +1 sort of a CC, constant currency growth, but the better numbers would likely be from the mid-tier players in the IT space. Again, on the IT side, I would believe that most of the negatives are broadly in the price. If you were to take a next 2 to 3 year point of view, these are basically buy on dips even for IT.
Right. And Mr. Sonthalia, last time we interacted, you were very positive on the entire insurance space, life as well as health insurance. Does that conviction continue?
Absolutely. I would believe that on a sequential basis, the health insurance names would see some sort of an uptick in terms of your profitability. The combined ratio would likely be better than what you have seen in the previous 2-3 quarters. And long-term trajectory in any case remains okay. And the valuations per se are very, very reasonable. Likewise, for even the life insurance players, even in the first quarter, their NP growth was very, very decent. So again, out here, life insurance has not seen too much of an action in terms of over the last 2-3 years. But now again, it's time for the life insurance space to look up.
Right. So Manish, while we interact with the other market participants as well, they are always flagging off that concern with respect to the valuations, lower growth earnings, and what will eventually be the case with respect to the tariff. While it's good to note and it's good to hear from you that it's a buy on dips market as per you right now, but don't you think that there are some concerns for the markets of late, or are you also penciling in some of the risk factors, or it's all good for the markets right now?
Markets would have something to worry about at all points in time. We have never seen a market in my last 30 years where they don't have anything to worry about. Everything is hunky-dory. So having said that, you look at the anecdote as far as the valuations are concerned from the point of view of earnings. Fourth quarter number earnings was the best for the mid-cap and the small-cap space. And that is where the maximum concern on valuations have been. While the Nifty 50 reported 2% YOY growth in the fourth quarter, operating profits were around 5 or 6%. The same number for, let's say, Nifty 50 next was around 27% growth. For, let's say, Nifty 150 mid cap index, the earnings growth for fourth quarter was 21%. For the small cap 100, it was, or small cap 250, it was 20%. So, when the whole Nifty 50 is seeing a low single digit sort of a growth, the better growth numbers are coming in from the broader markets. Having said that, yes, historically, the median valuations of Nifty 50, Nifty 150 mid cap was around, let's say, 30 times, and today the index is valued at around 35 times. You'll have to remove the outliers. You have very high allocations in some of the stocks which are trading at more than 100 P. So lopsidedness on some of the allocations in index gives you a very skewed picture as far as the index P multiples on the mid and small caps are concerned. But overall earnings trajectory for the mid and small caps are going to be much better even for this quarter. While the Nifty 50 earnings growth is likely to be in the range of 3 to 8%. The mid cap index projected earnings growth is going to be around 22-23%. And even for the small cap index, earnings projection is going to be around 10 to 15%. So it's going to be better than the index per se. And I think front-loaded dose of liquidity and cost of capital will only keep valuations slightly elevated. And there's going to be price asset inflation, according to me, because of the RBI actions, and that would be supportive of the market as a whole. So if one was to assume that markets will fall off a cliff, I wouldn't think so. And in any case, I think markets don't remain in an equilibrium. They undershoot or overshoot. This time around, because of the earnings support as well as the RBI actions, markets are more likely to overshoot rather than undershoot or stay in equilibrium.
Okay, and Mr. Sonthalia, also give us your sense on some sector-specific moves. Pharma is a space that you've liked for some time now, but the big overhang of that 200% tariff on pharma still continues. Does that change your stance on pharma, and do you believe that this 200% tariff could actually materialize on the space?
No way. I would believe that first of all, you have a holiday on that tariff for the next 1.5 years, 1.5 years. And 200% tariffs in any case is not doable. Even after, let's say, 1.5 years, you'll have something coming up on that front. Generics is what supports the pharma industry in the US. And, if this is the amount of tariff, then obviously if there's a pass-through of this 200% tariff, it's going to be extremely adverse for the healthcare sector as a whole for the US. So, of course, yes, there's articulation that up to 200% tariffs put on. But in all practical sense, it's not doable. According to me, even after 1.5 years, there'll be something to give.
All right, but sticking with the tariff, Manish, everybody is waiting out for that final number with respect to the India-US tariff. But this time seems to be a little different, Manish, with respect to the market reaction we have seen on April 2nd. Because from then till now, with respect to the other geographies, Donald Trump hasn't made any big changes in terms to the numbers. Do you believe that if at all for Indian markets, if we also come nearby to that 26% odd mark, it will be very well digested by the markets?
No, I think 26% would be taken very adversely. I think 10 is already there. Any number between 10 and 15 would be positive for the markets. The more than that, I think this 500% tariffs, because we import oil from Russia, that is to be given more importance as to whether that's going to come or not come. But otherwise, I think markets are digesting today a number between 10 and 15%. If that be a case, then it would be a relief for the markets. Anything more than 15% in the vicinity of 20% or 26% would be negatively looked at by the market.
Okay, that's the take on the entire tariff front. But Mr. Sonthalia, what are you making of the tariff impact on the entire US macros? We've seen the bond yield that spiked up. The dollar index continues to be under pressure. Do you believe that tariffs are doing more harm than good to the US economy at present before they start playing out for the longer term?
Absolutely. There's no doubt that, ultimately the tariffs are going to be paid by the American consumers, give or take a bit here and there. That's about it. And it's going to be quite inflationary. And from the point of view of the fact is the repercussions on the US dollar, I would reckon it is headed on the downside. And, if that be the case, then it's going to be beneficial for emerging markets. India is a part of the emerging markets rate, and it would also tend to benefit from flows.
Right. Okay, Mr. Sonthalia, appreciate you joining us this morning, and also thanks for all of your views, and great chatting with you this morning. On that note, we'll let you go.
Thank you.